welcome to the Currency Exchange, NatWest Market, where we help to break down the major themes and events driving markets in this week's and the weeks ahead. Today I'm joined by Alvaro Vivanco, who is our head of ESG and EMFX strategy here in NatWest Bank. Alvaro, we have seen some high carry EMFX really come under pressure in recent weeks. Is this just the story of kind of dollar strength reasserting itself, or is there more idiosyncratic things at play here?
Thank you, Eimear, and thanks everybody for joining us this week. Yeah, it has absolutely been a few exciting weeks for emerging markets, especially those high carry currencies, especially in Latin America, that have seen substantial moves over the past couple of weeks. And I think it's definitely a combination of factors. The dollar strength is definitely there. It has been across not only Latin America, but other regions as well, that we have seen some weakening of currencies. But I think what happened for some of these high carry currencies is that, some specific events, and especially the elections in a few places, but particularly in Mexico, prompted some sort of correction and kind of a revisioning of the theme of just chasing carry for the sake of carry. So what started as an expected election in Mexico, where the incumbent party was expected to remain in win the presidency, got a little bit more support in Congress than the polls were indicating. We don't think that this necessarily is a game changer in terms of policy over the medium to long term, but it certainly reignited some fears about the long-term policies, and not necessarily related to macroeconomics, but more in terms of broader reforms, especially around the judiciary. So basically, what has happened is that these very complacent, long carry trades in Latin America has been shocked, and we have seen some unwinding of those positioning that has led to pretty substantial moves, not only in Mexico, but across the region in Latin America. And we've seen a little bit of the same dynamic to a much less degree in other regions. So I don't necessarily think that it's purely this domestic idiosyncratic factors that prompted this correction, but I think it was more a bit of an excuse for the market to reassess those positions. We had pointed out that in some cases the valuations were already quite stretched and the positioning was already quite long in some of those currencies, and now we got those headlines, and those headlines gave way to sort of unwinding of that, and then more broadly kind of an opportunity, I think, which is pretty healthy in my view, for people to really take a second look and see how much value there's actually is in those currencies beyond kind of the immediate appeal of just high carry compared to the dollar.
Yeah, and I guess now that you've had such a shakeout of positioning, and they're trading a lot cheaper, especially in Mexico, do you think these local concerns will continue, or do you think this is a value opportunity?
That's a good question, and I think the answer depends on which country we're talking about. I think in cases like Brazil and, for instance, Chile, which we have already liked before some of this correction, value has certainly been created. I think that in these countries the idiosyncratic rates are more than priced in. We've already seen some the slowing down of the U.S. data as well, right? So the period of kind of relentless dollar strength could also be questioned in the second half of the year. I think we have some other sources of global uncertainty, but I think we have perhaps a little bit more clarity in terms of developed market central banks. And the bottom line is that U.S. rates throughout this period of pressure on EM have actually been very well behaved, right? In some cases, we've seen lower global rates, which is certainly positive for EM. So I think that in those cases there has been an opportunity to add some longs in these currencies. I think in other cases, in the region that I cover, in LATAM, in Colombia and Mexico, there is still some uncertainties. I don't think the uncertainties are huge or, again, kind of a game changer in terms of the long-term direction of policy, but the positioning had been fairly long already. So we're still kind of in the process of getting out of those positions, and it's always very difficult, right, to spot exactly the shifting point. But I think eventually there will be opportunities in these currencies as well. So the bottom line is that there has been some headlines that for the first time in a while have hit emerging markets, which I think to some extent is good and is healthy. There has been a revision of positioning, but I think that the long term viability of these currencies, given the fact that they still have substantial carry, remains in place. So we are a little bit more tactical in some other currencies, more constructive in others, but there's certainly been value being created in some of them. I think for other regions as well, and I would like to put the question back to you. I think South Africa was a good example of these election fears, right, that led to some changes in the coalition. It seems like some of those are out of our way now. It's more about monetary policy. But what's your view about the rand and South Africa in general?
You're absolutely right. We had those kind of big election concerns in South Africa where, there was the risk of this extreme far left party that was kind of campaigning to nationalize whole sectors of the economy coming into power. So we really saw, a sell-off in the currency on a worse than expected outcome for the incumbent. However, it actually looked like the market's best case was realized, and this proposed kind of government of national unity actually involved the incumbent kind of teaming up with a very pro-business and deregulation party. However, I think that kind of post-election rally has slightly hit a wall at the moment when the realities of a coalition government have kind of come into clear view. You have the two parties really struggling to actually announce a new cabinet as both sides play hardball. I think this is kind of a normal reality of negotiating, coalition governance, and it doesn't kind of change our overall optimistic view. I think, putting politics to one side, I think the bigger story is actually about monetary policy. We are in a global environment where, central banks, are easing rapidly or on the cusp of easing policies. And actually, South Africa could be, swimming against the tide. It's got a central bank, who's almost on a mission to lower the inflation target, to move it down to a point target around the 3% level. And arguably, what that means for central bank policy is that it could actually hike rates or keep them higher than what they expected to, than what the market expected to. I think it was interesting, once we had this rally in the currency, the market just automatically thought stronger currency, they'll be able to cut interest rates. And that's what we saw priced into markets. But I think that is really misplaced and it overlooks what's going on in the fundamentals of the currency. South Africa, is relatively cheap. It's very attractive in terms of return. You've got a very steep curve. You've got high carry on offer. So I think there's a lot of reasons for investors to get positive on the currency, especially if you've got a central bank that could actually, start hiking or definitely hold rates unchanged wherever else is easing. It's very quickly going to pick up that carry advantage. Well, that is probably about all we have time for today. A quick rundown of EM. If you did like the podcast, please do click like and remember to subscribe so you get the latest episode first. Thanks again.